This is a continuing video on the FASB conceptual framework, and in this case it deals with the elements of financial statements. So let's go ahead and look at again the outline of the conceptual framework, and in this particular case we're interested in the elements of financial statements. And the elements of financial statements are the building block with which financial statements are constructed according to the conceptual framework. It also includes the classes of items that financial statements are comprised of. The elements focus directly on items relating to measuring an entity's economic performance and its reporting of its financial position. Now in the next slide I'm going to go ahead and talk about the definition of the 10 elements that the conceptual framework mentions. Keep in mind that these definitions are definitions out of the conceptual framework, and you're going to see variations of them from textbook to textbook. So we're going to look at the first 7 out of the 10. We're going to look at assets. Assets represent present and probable future economic benefits controlled by the enterprise, or if you will, the entity. Liabilities are probable future sacrifices of economic benefits arising from present obligations of a particular entity to transfer assets or provide services to other entities in the future as a result of past transactions or events. Equity is the residual amount of the owner's interest in assets after subtracting out the liabilities. Also then, when we talk about areas of equity, we also separate the amounts that are invested by the owners. That's either a capital contribution by a proprietorship or a partnership, or the purchase of equity in the case of a corporation. And we also have a distribution to owners. Okay, the next definition of an element is what we call revenue, and these are gross inflows of assets resulting from providing goods or services, typically to customers, expenses or outflows, or other using up of assets. And what I say using up of assets, that'd be something like depreciation or occurrences of liabilities during a period from delivering or producing goods, the rendering services, or other activities that constitute the entity's ongoing major or central operations. Okay, we go on to the last 3 elements. The first one is gain or gains, and these are increases in equity from some peripheral or incidental transaction of the entity. We have the opposite of the gain, and that's losses, which represent decreases in equity arising from peripheral or incidental transactions of an entity. Lastly, we have the definition of comprehensive income, and comprehensive income is one of those areas that seem to give accounting students and even accountants kind of some problems. But the definition is comprehensive income is a change in equity of a business enterprise during a period from transactions and other events and circumstances from non-owner sources. It includes all the changes in equity during a period except those resulting from investments by owners and distributions to owners. One way of saying this in a nutshell is comprehensive income results in changes in equity that did not flow through the income statement. But again, we will get more into comprehensive income in later video. Liz will get into those in her videos, and I'll get into comprehensive income in my future lectures. Okay, now these financial statement elements are organized typically, if we have to create a full set of financial statements, the FASB conceptual framework says we should create 5 sources of financial information. The first one being the statement of financial position, which is a summary of economic resources and claims against those resources, very importantly at the end of the period, in other words, for a point in time. This includes assets, liabilities, and equity. We should also include, according to the conceptual framework, a statement of earnings, which is a summary of earnings for the period, okay, not for a point in time, but for a period of time. In other words, typically between 2 balance sheet dates. And the earnings elements would include revenues, expenses, gains, and losses. The next item that we should provide is what we call the statement of comprehensive income. And it's a summary of comprehensive income for the period, and the major element is comprehensive income. And again, that includes the changes to equity that did not go through the income statement. Next is then the statement of cash flows for the period, which are cash inflows and outflows for the period. Again, importantly, it is for the period, not for a point in time. And again, those elements are organized into different types of activities, which include investing activities, operating activities, and financing activities. Lastly, we need to include a statement of changes in stockholders' equity, which includes investments by and distribution to the owners of the entity during the period, and that includes the elements of investment by owners and distribution to owners. Now, one of the important things we have to understand is that for the most part, everybody says, well, wait a minute, I'm only familiar with the statement of financial position and the statement of earnings and the cash flow statement. What about these other statements? Well, the conceptual framework allows you to combine financial statements in many cases. As long as you have the information flowing from these 5 areas, you can do a number of combinations of the financial statements, and typically you end up with the statement of financial position, the statement of earnings, and the cash flow statement. Now on the next slide, we're going to talk about a number of other definitions that are also set out in the conceptual framework. And a lot of these definitions are related to accrual accounting. As a matter of fact, we start off with accruals, and that means we anticipate future cash inflows and outflows for utilizing accruals. And we recognize assets and liabilities with related assets, liabilities, revenues, expenses, gains, and losses. Deferrals reflect past cash flows. We recognize liabilities from cash receipts and assets for payments with the deferral of related revenues, expenses, gains, and losses. We also have the concept of systematic and rational allocation, which means the assignment or distribution of an amount according to a plan or formula. Amortization is simply a form of allocation, and that's the allocation process that we use for deferrals and accruals. Now, 2 very important terms here, and the first one is recognition. Recognition, when we say we recognize a transaction, that is when the transaction is formally incorporated into the financial statements of the company. So when the transaction is actually recorded, that's when we recognize a transaction. Realization, on the other hand, is a little bit different. It is when we convert non-cash resources into cash or claims to cash. So that's what realization is. Okay, with that, we're going to now take a look at the 3 multiple choice questions of the type of questions you could find on the CPA exam. So let's go ahead and start with question number 1. Number 1, according to the FASB conceptual framework, which is an essential characteristic of an asset? Again, you have 4 choices. Stop the video, make your selection. When you're ready, restart your video. Okay, number one, according to the FASB conceptual framework, which is an essential characteristic of an asset? And in this case, the best answer is an asset produces future economic benefits. And that's really the essence of what an asset is. Okay, let's take a look at number two. Now, what we're going to learn here is number two is a training question because we didn't specifically address this question in the video lecture. So, according to the FASB conceptual framework, asset valuation accounts, in effect contra accounts, are considered, and again, pick what you feel is the best answer. And when you're, stop your video first, and when you're ready to when you're ready with your answer, go ahead and restart the video. So number two, according to the FASB conceptual framework, asset valuation accounts, in effect contra accounts, are D, neither assets, liabilities, nor equity. They're simply offset accounts to assets, liabilities, or equity. Okay, number three. Number three, according to the FASB conceptual framework, which of the basic elements of financial information are not required in a full set of financial statements? And again, there's four choices. Stop the video. When you've made your choice, go ahead and restart the video. Okay, number three, according to the FASB conceptual framework, which of the basic elements of financial information are not required in a full set of financial statements? And in this case, the answer is C, investments by and distribution to owners at the end of the period. And the reason this is this is not required because it's incorrect. It should say, if it was to be included in the financial statements, it would say investments by and distribution to owners for the period ended, or for a period of time. It's not investments by and distribution to the owners at the end of the period. And that ends question number three. So thank you very much for viewing this video, and I'll see you in the next video.